Welcome to the Retirement DNA Podcast. I'm Aaron Johnson. We believe you deserve financial advice based on your best interest. In our podcast, we'll discuss all aspects of retirement planning. Today, we want to talk about mutual funds and ETFs. What are they, and what are some of the differences? So it's a very common question, and if we took 100 people off the street and asked them how a mutual fund works, the majority of the people would have no idea. They know what they are, they've heard of them, but they don't know exactly how they work. And if we ask those same people what an ETF is, 95% of them would say the same thing. They've heard of them, but they don't know how they work. They don't know what ETF even stands for. And they don't know what makes them similar to mutual funds or different than mutual funds. So that's what we kind of want to talk about today, because this is a question that we get asked all the time. So just a little bit of history on mutual funds. So the stock market in the 1920s used to be mainly just strictly for wealthy people and institutions. The average person didn't own stocks and wasn't in the market. So we had the big crash at the beginning of the Great Depression, but only about 8% of people actually owned stocks. A lot of people think that in the Great Depression, people lost a lot of money because the stock market went down. Well, only 8% of people actually owned stocks during that time. But it was the aftermath of that crash when businesses started shutting down and all of that's where people really felt it. So in the late 1920s, America's first mutual fund was started. They decided that they wanted the average person to be able to own stocks and be in the market. They decided that it would actually have a manager that would pick the stocks. The average person could invest however much money that they wanted to into that fund, and the manager would pick the stocks that go into that fund. And the investor would just own a share of those stocks, would own a share of the mutual fund. That manager would decide when to buy and when to sell for the investors. That mutual fund was actually called the Massachusetts Investors Fund. And it's actually still around today and is owned by the mutual fund company MFS. So the mutual fund was started to let the average person buy stocks and to get into the market. So on down the road come IRAs, 401ks, 403b accounts. And that really seemed kind of like the perfect place for mutual funds. You could buy in at small amounts through your paycheck and every time you got paid. So now the vast majority of the people have access to a 401k or a 403b or 457 or some type of employer plan where they can own a mutual fund. And having a mutual fund in there was made investing easy. They may not know necessarily how it works, but they know that it's put in the market, and they're all different types of mutual funds. And the average person doesn't really know how to pick stocks or what to look for. And by having a manager on a mutual fund, it just left that up to him and his team. So what are some of the advantages of a mutual fund? Well, you can buy them for a small amount of money, and even still, you can buy into them for a small amount of money. Most mutual funds, you can start with either, $25 to, roughly $250. But if you set up an automatic contribution, then you can get into it for typically as little as $25 a month. The mutual funds also make investing easy, right? You can just put the money in and you get a diversified portfolio that owns anywhere from 50 to about 300 different stocks or bonds. So it was easy for the vast majority of people that they can own a diversified portfolio all within one little fund, if you will. So they're professionally managed. You can, like I mentioned before, you can set up automatic investments. You can also have automatic withdrawals set up. So if in your retirement and you need to have income from a mutual fund, you can set it up so that it automatically sells every month or every week or however you choose to do that. But so what are some of the disadvantages of a mutual fund? And there are several. So for one, it's kind of this black box, right? There really isn't any sort of transparency on what stocks or bonds they own. Twice a year, they send out a report that basically shows what they currently own. Maybe once a quarter, they send out a report and it shows like their top 10 holdings. But you can't see the trading that they're doing on a day-to-day basis. And they are selling stocks every single day and buying stocks every single day within that mutual fund. But you're not able to see that because there's that lack of transparency. But as I mentioned, they send out this report like twice a year or kind of once a quarter. You could go on and kind of check. But as of that date, it's out of date already. So by the time you see it, those stocks and holdings have already changed. So by the time you get that report, it already does you no good. So we don't get to see what they're doing every single day. Also, fees. And fees can really range on mutual funds. They can be from, a very low percentage to, a couple of percent depending on what they're doing and what stocks they're buying. They disclose exactly what the fee range can be, but not exactly what the fee is. And the return that they show you, so if they show you a net return of 10% and the annual fee is 1%, you actually returned 11, but they're only going to give you 10. So it's just another lack of transparency with mutual funds. You don't know exactly what you're getting or what the return is because they only show you the net return. I'm okay paying fees as long as I know that I'm getting some benefit for those fees. The other thing is that they only price one time a day. So you don't know what the price of that mutual fund is until all the stocks settle throughout the day, and that mutual fund can price at the close of business, which means if you want to buy the mutual fund or sell the mutual fund, you don't know what price you bought in or sold at until the day is done. So if you want to put money in or you want to sell some and take that money out, you can't put in a limit order. So if the mutual fund's dropping, you can't say get out at $10 a share. You just have to go in and sell and take whatever price they give you at the end of the day. So you can't see until after the fact. Also, tax inefficiency. Most mutual funds are not very tax efficient. If you own them in a retail or a non-IRA account or a brokerage account, just a mutual fund account, they generate a 1099 every single year. You're taxed on the dividends each year, and since they're buying and selling every single day in your mutual fund, you could have a hefty capital gains tax even if your mutual fund went down for the year. And many of you have probably already experienced that. And we never know what the capital gains rates or the dividends rates are going to be each year, so it's hard to do tax planning with mutual funds in non-tax efficient accounts. There are lots of benefits to mutual funds, but there are negatives as well. Mutual funds were built really to accumulate money. They've changed over time, and some funds are trying to be more tax efficient, but they still have a ways to go. It's important to use mutual funds in the correct account types. And for more information on correct account types and locations of assets, you can listen to our other podcast that talks about asset location and its importance. So that's mutual funds. So now let's talk about ETFs. An ETF is an acronym. It stands for Exchange Traded Fund, which that really doesn't tell you much more about what they are than the name. But in the 1970s, a gentleman by the name of John Bogle, many of you have probably heard of him. He's from a little mutual fund company called Vanguard. And he started creating these index mutual funds. So instead of trying to beat the market through active management, he thought, why not let the investor just mirror the index like the S&P 500? So the S&P 500 has the 500 largest companies in the U.S. That's the S&P 500 index. But do you think that those index mutual funds actually own all 500 companies that they're supposed to mirror? No, they don't. They own about 300, and then they call it good enough. So the great thing about these types of funds, though, is that they're very cheap. So the expenses have gone way down because there's not any really active management on those funds. They're just trying to mirror the index. The expenses on these funds continue to go down as more and more companies get into index funds. If you want to own small companies, you can own a index mutual fund that invests in the Russell 2000. If you want to own, there are mutual funds that follow the index of gold. So there are a lot of things that you can do now with those index funds. So they're getting better at mirroring an index for a lower cost, and they're more tax efficient. As technology is advancing, so are the different investment vehicles. And that kind of what brings us up to exchange traded funds, or ETFs. So in the early 90s, State Street Global Investors, the company, and a few others came out with kind of the first modern day ETFs. They liked what Vanguard was doing with the index funds, but they still had things they didn't like about mutual funds. Now come the ETFs. They're still diversified among a lot of different stocks. A lot of them follow indexes like the index mutual funds do, or bond indexes. But ETFs can now be bought or sold throughout the day. You can always look up their ticker symbols, their little 3-digit ticker on Yahoo Finance or Google Finance or something else, and you can see what their price is doing every single day and how the trades are going. So you could buy and sell throughout the day now. You don't have to wait until the end of the day. You can also do options on stocks so that you can kind of help protect the investment that you might have. They also allow for greater transparency with their fees and with what they own. So they're changing on their sites every day of kind of what they're buying or selling. So they tend to mirror the indexes that they trade or that they follow a little closer. Nowadays, you can buy the ETFs that mirror just about any index you can think of: gold, silver, currencies, real estate, international real estate, the bond markets. You can do specific countries and specific industries. So ETFs allow you to kind of narrow your focus on what you're wanting to invest in. They also have inverse ETFs, leveraged ETFs, and now actively manage ETFs where they may not be quite as tax efficient because now they're buying and selling within those ETFs. The idea behind them is that the average investor can buy them. You can still do automatic investments. You can do automatic withdrawals. They are diversified. And several ETFs can be combined together to make a whole diversified portfolio. If you want exposure to a specific country and an industry, like I said, you can do that. And you can set limits now for buying and selling ETFs. And lastly, they're much more tax efficient because most of them are not actively traded. Your gain is realized when you sell the fund, just like with a stock. If you buy it at 10 and you sell it at 15, you've got a capital gain of $5 a share. An ETF, an exchange traded fund, works the same way. That way, you're not going to be surprised when you have a capital gain when your investment is down. You know roughly what your taxes are going to be on that sale. So ETFs basically corrected a lot of the disadvantages of mutual funds. Things will continue to evolve and get better as technology evolves. Think of how the iPhone has changed since its first one, 11, 12 years ago, right? They're now on the 12th version, and the 12th version is vastly superior to the very first one. The other way that I think that technology has really changed too, that we can see how things have evolved, is with how music is listened to in your car. One of the first cars I and my sister shared, we inherited from our grandparents. It had an 8-track in it. Well, by the time we got the car, we were listening to Walkman and the first portable DVD players, or the first portable CD players. So we had to connect our CD player to a cassette plug-in that then got inserted to a cassette 8-track converter, and that's how we could listen to our CD player as long as it didn't skip while we were in the car. And now many cars don't even come with a CD player because everyone is moving to streaming or podcasts or using Bluetooth in their car or even satellite radio. So just as technology changes with the way we listen to things in the car or our phones, it's also going to change with different investment vehicles. But just because an investment vehicle is new doesn't mean it's a good fit for your portfolio. There are a lot of crazy products that are out there that get very, very complicated that just don't make a lot of sense for people's portfolios. But give us a call and we can help evaluate your overall portfolio and also do a risk analysis for you. We want to make sure that you're getting the correct amount of return for the risk that you're willing to take. So our main goal at the Dwayne Johnson Group and Bridger Financial Services is to make sure our clients know that they can make it to and through retirement and can spend with confidence during those years. We want to make sure that they have financial security in any economy. Thank you for listening to the Retirement DNA podcast today. If you have any questions or would like to sit down with us for an initial consultation or a review, or to just see if you're on track to meet your secure retirement, please give us a phone call. Our number is 951-244-6702. Again, 951-244-6702. If you've liked what you've heard, please subscribe to our podcast. And please tell your friends and family if you think that they could benefit from hearing this information. You can also check us out at DwayneJohnsonGroup.com or BridgerFinancialServices.com. Thank you and have a great day.
Investment advisory services offered through Bridger Financial Services, LLC, a registered investment advisor in the state of California. Insurance products and services are offered through Dwayne Johnson Group, LLC, affiliated company. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Dwayne Johnson Group, LLC is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Dwayne Johnson Group, LLC.